Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
All right, this week on Swimming with Allocators, you're honored and blessed to have your two co-hosts here, Alexa Benz and Ernest Sweat, in the final episode of the year, final episode of the season 2, for your fan favorite DDQ episode. So this is DDQ number 5. Somehow we've gotten to 50 episodes. It's crazy. Alexa, how do you feel?
Man, I feel super grateful to those first LPs who came on the very early episodes, and any of you who have been listening to multiple episodes, thank you too. I think now it's actually really been normalized that allocators are open to speak to us and speak to other podcasts too about what they're looking for in venture, and that's a huge win for everybody in the ecosystem, I think.
It is. Although I don't care about the other podcasts, they should all it's not real until you come on here. We'll get into that later. But it started from just a dream, and the forcing function, I have to thank you, Alexa. I'm really big on names. I'm really big on concepts and ideas. And when there's a little idea that's just like burrowed in my head, I feel like I have to get it out. And when you came up with the name, I was like, we have to do it. So thank you.
Yeah, if anybody wants to be repping Swimming with Allocators, we can get you merch. It's on our website.
Yes, please go get it. We can have a little thing below.
If you love the name Swimming with Allocators as much as Ernest does, then you need some gear.
So a reminder on DDQs. This is an episode where Alexa and I will discuss a few topics that are going on within our industry of venture capital and things that we've learned from our numerous conversations on the record and off the record with the allocators. We also debate a few things, and then we'll answer a few questions that come from our community. And this is going to be a special one given it's the end of the year. So you can expect a lot of reflections. And so we'll jump first into our first D, which is discuss. And Alexa, I'll let you start us off.
Sure. One of the things we've been hearing from a lot of LPs lately is how the nature of their job is changing because of RIA roll-ups. And I can give a little personal context. I think if you were raising capital for venture as recently as 4 or 5 years ago, RIAs felt like a real blue ocean opportunity. You know, you'd sit down with these guys and they'd say, you know, we're really haven't done much in alternative assets. We recognize it's something we should be offering our clients. Goldman's doing it, et cetera, but we haven't quite figured it out. So I think everybody was kind of humming and hawing on what the right strategy was to bring things like venture deals to their clients. And you fast forward the past few years, all the RIAs have been getting rolled up, and so they're collecting, the PE guys are collecting the assets under management fees. And the latest thing they've added to the strategy is the OCIO. So first they collected all the clients, all the high net worths, and their wealth managers as salespeople. And 2024 has been the year of PE buying up the OCIOs. So I'll rattle up just a few of them. Mariner Wealth Advisors announced plans to acquire Co. and 4th Street to perform as partners. Cerity Partners has joined with Agility. So that's now Cerity Partners OCIO.
Wow.
Pathstone, a favorite family office advisor that we know well, is acquiring Hall Capital. And then Sarah Samuels, who I just mentioned, she's been advising pensions and endowments at NEPC, and they've just been acquired by Hightower. So the strategy, if you are approaching these RIAs now, is actually going to be very similar to what you experience with the individual endowments or some of the smaller foundations, where they're also now going through the consultants.
Yeah.
All these OCIOs are now the front door to these high net worths who are working with RIAs. So it doesn't actually, I think it's still a positive sign that there's all this private wealth, this like democratization where individuals can now get access to like best in class research being offered by folks like NEPC, but the strategy to meet these decision makers is going to feel maybe a little more tiresome. And it could really be one of these consultants who like makes or breaks your chance to break through and become a, historical name brand fund.
I will say that some things that, after hearing these conversations about the roll-up opportunities with PE taking over outsourced CIOs, I think one issue that's going to happen is, are you even going to be eligible for what they're looking for now? With so much capital and AUM under management now, does it make sense if you were looking for this foundation or this organization to provide you with a $5 million, $10 million, even $20 million check? Does that make sense for how big their team is, how much capital they have under management now? Because a lot of times in these roll-ups, they're seeing that, like you said, Alexa, venture was something very new, so it wasn't much exposure. So how do they get right-sized in the right amount of allocation at the right amount of time? Is that going to be a bigger opportunity for your kind of well-established, bigger players who continue to raise billions of funds? So I'm really thinking about, who does it impact within our kind of emerging, established, and mega fund kind of categories, and who's going to benefit from it? I think it's kind of goes with the consolidation and the impacts of consolidation within just the industry overall, and pretty much every industry today. You're starting to see a similarity, or I've been able to pick up a similarity between allocators, especially mid-career allocators, being involved in kind of roll-ups and consolidation, feeling the same pain points as those individuals who are at firms as GPs, young GPs at firms that are starting to get bigger and bigger and bigger. And so I think there's a lot of similarities, a lot of frustrations of like, what can I actually focus on? Is it about, preserving capital more than actually finding alpha? And so I think the result of that is going to be more changes and more of a merry-go-round for allocators, because it's really getting that point, an inflection point in the industry, an inflection point in a lot of people's careers of like, hey, I have a balance of youth and wisdom of like experience. Should I do like a lot of the GPs are doing and spinning out, or taking up opportunities at younger firms? And so I think we're going to start to see a lot more of that. And so there's a lot of talent out there.
No, I think that's a super helpful point of empathy that you as a VC pitching an allocator may not have had in the past, which is just like you get crazy conviction on a deal. You're trying to convince your team to do it. Maybe they're not into it. The allocator is often in the exact same seat. And so you very well may be their thing that they say, oh, you don't quite fit into all of the categories. You don't quite check all the boxes that we're looking for right now. But they're still obsessed with you, and they are handcuffed a bit, despite having real conviction.
Yeah, and so it's why you need to have real touch points and develop really real relationships. No real relationship in any aspect of life is just me pitching and always telling you where things are going without there being something that's reciprocal, right? So. Yeah. As GPs, as aspiring GPs, please ask questions, understand what is actually going on with your allocators or potential allocators. What drives them? Is there an alignment on what you're offering, and it fits kind of what they're looking to get and what they need to do to succeed in their role?
Yeah. Absolutely. Another thing that every LP seems to mention these days is co-investments.
Yeah.
Co-investments. What are you hearing from them on co-investments?
Co-investments have been something that has, over the last 5 years, so about half of my venture career, has been creeping up more and more in an interest of, not only family offices, but as we get more and more institutional up the LP stack. And I was having a conversation with some junior team members of a pretty large endowment in the SEC, and they were speaking on just like their process of, when it comes to their venture program, investing in pre-seed and seed funds, and over time getting really aggressive on co-investments. And first, kind of dabbling their toe by doing SPVs, like most kind of co-investments, but now looking to be more of a player by investing just off as their investment company. Being able to establish those relationships on their own. And so for me, is what's really has me thinking is, I understand the interest, but the question that keeps coming to my head is, are allocators the best suited to do this co-investing? Mm-hmm. And because they have also full-time jobs that are quite difficult, especially when you look at venture capital, where unlike some other asset classes, venture is really determined on you picking the right manager. And some of that is a little bit luck. A lot of that is probably really luck. But you need to have like criteria and a way to even just have access to those right managers. And so given they have to do that, given that a lot of times they're also looking at other asset classes too, there are kind of two strategies in which you can do, right? One, you can be passive and like as deals come up, you can do them if you trust those managers, they're already in your portfolio. Two, you can have a team dedicated to it, or just put people dedicated to it where they split time. And still the question comes up, will you have the dedication to have that access? And then thinking about the portfolio company is like, what are you offering? What's the value add? The same questions you ask as fund managers. So it seems like it's an opportunity now because a lot of people want to do it. Where I come and the question I ask you is like, how can your GPs service allocators better to build that muscle?
Yeah, it's a really good question. I think partially you have to, it's to your benefit to recognize that the co-investment is really what they're talking to you for. Like maybe you are a truffle pig hunting on behalf for that. Like they're going to end up putting the same size check into your fund as potentially many of your portfolio companies. And that's sort of a painful thing to swallow, but recognizing what job they're hiring you to do. And they're willing to pay the 2% management fee for the access, but then like the expectation is you're also going to deliver some of these other great opportunities. Particularly I think for like the family offices, I got to look at the Global Partnership Family Offices, GPFO, has a report they put out recently where co-investment was a big piece of what their report was looking at. It's the Family Office Private Markets Benchmark Report 2024. And broke it down for me by like how do people even define co-investment? Why are they doing it? As well as, what fees are people willing to accept? And I think one of the things that really jumped out was the special expertise of the investor was one of the key benefits that they were looking for, as well as sharing the due diligence resources. So it really is your opinion as a GP on why this deal is really special. And it also potentially, sets you up as a true specialist. Maybe
Yeah.
the only thing you're a specialist on is like this particular founder dynamic or why this team is so exceptional and what the rest of the market doesn't know about them. But more likely it's going to be a thematic, like that you are a deep expert on, whether it's, hard tech, frontier tech, climate tech, etc. So I think that helps on your pitch as you're presenting the opportunity to family offices for sure.
Yeah, and I personally, if anybody has any ideas and wants to reach out to me or have conversations as an allocator who's, what best practices they've done to develop the muscle or are actively trying to do that, whether you're an endowment or anything in between, I would love to have a conversation because I actually think there's an opportunity as well for, recent spin outs or people that are looking to warehouse deals for a partnership between those individuals with the experience to also be able to show, actively in real time deals and getting some type of like starting a relationship and compensation on the in that manner, right?
Yeah.
Because I think it's not only finding deals, but if you're able to also show value and be a point person, I think it does a lot of things. It helps that allocator understand how to, do deals, diligence deals, turn them inside and out, but then also how to really add value in an intentional manner. And so it kind of it's not a pledge fund, it's not a SPV per se, but it's more of a finder's fund or something like that. So if somebody wants to talk about this kind of like concept of an idea, I would love to.
Yeah. And I think to address your question of like, is this the job that allocators have the time to do, let alone the skill set to do? I think they are pretty self-aware and fall into a couple camps. There's groups that are just going to index and they're going to do most of the co-investment deals that they're brought because the hard work that they did was in selecting the managers.
Yeah.
And therefore they believe you and they trust you and they're going to do what you share with them. Versus those that are maybe like deep on an industry, a family that's coming from textiles, et cetera, who are going to go deeper on some of the industries that they have personal experience with, and are not they're not playing a statistical game. They are themselves the industry experts. Now it's time for us to debate. Lovely discussion on what we've been hearing from LPs. I would love to ask you, Ernest, about coming markdowns. So VCs are in an interesting position where we are beholden to the founders who make it rain on behalf of each fund, but we are also beholden to the LPs who are the customers over the long term.
Yeah.
So
they also make it rain, but yes.
So I think everybody gets to decide for themselves how what processes they want to put in place in order to mark their books. You have to have a strategy written down, but you can write that strategy however you like. So obviously the LPs they've been asking for transparency. They've been asking for no surprises. They also have data on the same portfolio company across 3 or 4 different funds. And so it's not like your marks are the only marks they're seeing. Do you believe the optimists, the ralliers, the hype men are ultimately the ones who are going to end up doing better across the board? or the, you know, more pragmatic style GPs who have potentially already marked some of these companies down, are leading with some of the not great news or sharing some of the, concerns they have about some of their big winners in the portfolio?
I think, I wouldn't even call them pessimists, but I think the realists
Yeah.
are the ones who are going to win, in my opinion, because more than ever, you need to have strong relationships with your sources of capital. With so much uncertainty, and what I'm anticipating is going to be some pretty volatile markets, and be good as well. And I think in the beginning of 2025, but who's to say it won't be volatile after that on the other side? And so I think being able to have a level head of where you think those marks should be, and reminding your capital sources, the allocators, that we have a good eye on what we think will provide DPI, and we, because of these opportunities in the market, possibly doubling, tripling down on those certain companies and having a criteria for it. I think that'll go a long way for you. And those VCs that were honest about where things were, where they made mistakes, what they learned. We heard this, throughout this year. What, if they shared what they learned and how they're going to approach things differently.
Yeah.
And so
Yeah.
that's what you want to be able to kind of establish in your relationships, that, hey, I'm a signal caller, and I ignore the noise.
I mean, or to play devil's advocate, you're trying to raise your next fund right now. So why are you going to make your, okay, there's a lot of good arguments to say we still don't know. The founder is holding this company at the last price. I'm not the one who's going to go, rock the boat. I got to keep these guys working hard. I want them to continue to be motivated. I've been telling them they're one of the strongest companies left in the portfolio. Everybody else has it worse.
Yeah.
And potentially they need follow-on capital at some point. It is not to your advantage to necessarily share all of the concerns that you have about your biggest, your theoretical biggest winners. So I don't know. You keep it at the last price or even half instead of cutting it a second time, and you're able to go out and raise your next fund because, everybody agrees, like, it's too early to tell. We don't actually know what AI is going to end up doing to this industry. Or, for now, they've got a lot of cash in the bank. There's a lot of ways you can sort of.
Yeah, but you want to keep the line above board. And I'm not saying, hey, VC is about vibes. If it's about, if people don't, if there's one thing people take from this entire conversation, it is about vibes. But you can't be too delusional,
Totally.
right? Just like, founder with founders. And so I think it's one piece on sharing kind of like, hey, we've been conservative and marked or kept it at the same price given what we see in the public markets. But also we're, for my situation, it'd be like, I'm still an early stage investor. So I'm not thinking about, what's going on in the next year. It's about like where things will be in the next 7 to 10 years. And so you're still going to give those vibes of positivity and because you believe it and have conviction. But if you've made glaring mistakes and got involved in, hype loops, you have to address that.
Yeah. I think there's often also, you're describing, being a super early stage investor. You have very little information in some cases on some of the companies that are the big markups of your portfolio. And so it isn't, your best guess on if there hasn't been a repricing.
Absolutely. Something to think about. There's the old adage that you are what you eat. My question for you in debate is, what, let's say you're a GP, who should you be targeting as your customer LP, right? Should it be the SMBs? So that would be like family offices. Should it be mid-market, kind of like your smaller fund of funds, multi-family offices? Or should you go after the large institutional players?
Totally. I think partially it's like you want to sell to whoever you know is buying, right?
Yeah.
And so there is I think it's a really healthy exercise to outline who do we think in 2025 is actually going to be enthusiastic about venture and why, and be making some and actively taking some positions. The endowments, they're and the big institutions are highly concentrated in alts already, and they're kind of cooked. Like there's not going to be a ton of opportunity to swap in and swap out somebody new.
Yeah.
The sovereign wealth funds still feel like they are expanding, sort of like what percentage of the pie is going from traditional to alts. You've got maybe pension funds and stuff moving from like 2% to 4%. And then we've talked about the RIAs. The RIAs are now often going to approach things similarly to the small, like the other nonprofit endowments, et cetera. So there's going to actually be a lot of groups deploying there, but they're going to have some maybe more old school opinions on
Yep.
what a good manager looks like.
Yep.
They're going to be looking for third or fourth funds, et cetera. So I think it's sort of like narrow your focus on people who are actually buying when you're out selling.
Whether you're a founder or GP, and the equivalent being we had the rise of all these family offices, especially during kind of like 2020, 2021, 2022 jumping in. And then we also had some people who like missed it the last, some pretty notable pension funds that missed the last markup or rise up of the venture market. That being equivalent to, on the founder side, PLG, right? Product-led growth, going after small customers and then moving your way up the customer stack. With the world of more consolidation and automation, I think those are two like crazy concepts to be coming at the same time.
Yeah.
And a administration that is who the fuck knows. And so I think where I've been going and talking to a lot of, whether founders or GPs, is I think if you don't know how to sell to enterprise, at least for the next 10 years, what are you, it's not going to be sustainable. Like you're not going to feel, and I'm not saying it's easy. It's not easy.
Yeah.
But people who are able to sell to the biggest players of whatever their markets they go after, they will take advantage and get a huge lead. So learn how to develop those long sales cycles and relationships and do them in kind of a critical mass. Find all the different touch points that you can find if you're a GP. If you know that, keep in contact at an RIA now got rolled up, how can you start to make that an advantage of having multiple people who know your story and are developing some conviction in you, or you've been able to help them find some co-investments, whatever it is, but learn how to sell to the enterprise. So we're just going to rattle off a few predictions, and I'll let Alexa go first.
I predict that crypto is going to give people a lot of free capital, just that people are going to start feeling wealthy thanks to crypto. And so I'm going to predict that, speaking of high net worths, I would go pitch your crypto whale friends. I think those will be the easiest GLPs to land in 2025. Another prediction of 2025 is I think DEI is going to remain out of favor.
Is that a prediction, or are you just saying that the sky is blue? Because I think a couple of weeks ago kind of told us that.
I think what it actually means is like as I like the theory of invest where others are not necessarily investing. If you're investing where everybody else is investing, you're too late. So I think it's actually a really smart time to be looking at the kinds of categories and the kind of people who are not necessarily trendy. So I would say you're going to see more wins coming from some of the places that you kind of least expect them.
I think that we're going to start to see some pullback in the infrastructure plays when it comes to AI. And I think we're going to start to see more activity in the middleware and application activity. So I think, a lot of money has gone into whoever's going to attempt to win and kind of LLMs and small language models. And so I think more of the focus is going to go to those that are the application and middleware layers. Mm-hmm. And I think San Francisco is going to rock again. So it already is.
Interesting.
Yeah.
San Francisco's back. Ernest called it. And he has a pretty good eye for where there's a good time.
Yeah, I do. Well, I have one more. I predict that season 3 of Swimming with Allocators will be the biggest and baddest season that we've ever had, and we will have some of the best guests ever that no one expected us to ever have. So,
that is awesome. That tees up very much a question from the community. We're going to answer a few questions here that you all have asked us via social or in IRL. One was, who's a guest you'd love to have on the show?
So if you look at just like who we've had, and we've had amazing guests, and we'll have a lot of those people back on in season 4. I think that's when we start repeats probably. But there's been some obvious kind of like areas within the LP stack that we have not had. And so endowments. So I would love to have friends from Yale, especially after their, learning from their, prospect fellowship program in that process. MIT, Vandy, Stanford.
Appreciate intros. Yeah, appreciate intros. Good call.
Anybody you want, Alexa?
I would love to have a couple people on the show who are just not doing any venture at all to be able to give us that counterbalance. So that I think at this point, if you're pitching a fund, you really need to be able to pitch like why your strategy is one that is the biggest opportunity yet, why you're the right person to do it, and why this is better than any other asset class that they could also be considering. And so I think that would give some good perspective if somebody's saying, nah, I'm not doing any more venture right now.
Another question that we've received is, what's LP's return expectancy for venture today?
Yeah, totally fair. I mean, I think historically it's a huge range, like 3% to over 10% more IRR expected as the paid, to lock up that capital. And you've seen a bunch of endowments, for instance, like underperform because the markets have been rallying, the public markets have been rallying. And so having 30% in alternatives means you are performing below the market.
Hopefully we'll have some IPOs that market will open. It's anyone's best guess on how they'll do 6 months after, but that will provide some liquidity to the market, hopefully.
Okay, maybe final question from the community. What should we read this holiday season? Ernest, you often are the one mentioning different books.
Yeah, so my favorite books this year have been a wide range of topics. I would say To Make Men Free, which is the history of the Republican Party, is fascinating. And it also kind of shows, why America is kind of just an interesting place when the two most important documents, Constitution and Declaration of Independence, if you take those two ideals all the way to the top, they'll conflict with each other. So that was good. Anti-Fragile really just messed up my mind when it came to humans' like desire for stability and their desire to predict things when that's so silly. Just because you have a lot of data doesn't mean it's not just data filled with noise. And he really challenged me in this idea of like, how do you respond well to randomness? Because randomness is going to happen. And I think Power Law is one that was really good just on the history of venture. And if it was inspiring and hearing that every generation of kind of the next generational firm had to create their own path. What would you suggest, Alexa?
Oh man, this is a really random one, but we sort of get bogged down sometimes in our day-to-day lives and our like jobs and our to-do lists. The in-between is about a perspective of a woman who is a hospice nurse. And maybe December is a really good time of year to kind of take a step back and think about like, oh, what are the things that you're going to care about in the end? And I found the in-between was just sort of weirdly a feel-good way to get out of sort of like just thinking about work stuff and day-to-day life stuff.
I love that. What I love about this experiment called Swim with Allocators and what I've learned, I love that we just kind of had an idea and then we just started to watch it grow by, convincing, thank God for our sponsors over the 2 seasons, over the whole year that have, believed in you and I. And thanks so much to all the allocators who didn't know what we were, thought it was a funny pun, and we had just really like life-giving conversations. Not going to speak for you, but as somebody who's about to turn 40, it not only feels this year of being able to look back and forward of this past year, but it's like looking back and forward to like we're really mid lives, like midlife, yeah, just midlife. That's just heavy. But it's also inspiring. It just shows of like all the things that we've been able to accomplish. And so what stuck with me is like different quotes from different allocators. Like venture is a heartbreak gay. I think Chris told us that. Yeah, Chris. Sarah, who talks about just like seeing another woman who was commanding, and then that gave her hope. Or the whole, like, I think this one didn't make the episode, but this idea of there's a special type of bark that trees, have going through stressors that helps them grow. And if you don't have that, trees will just grow, but then fall over. And just that metaphor with like how to build your own resilience and what you're looking for in founders. And so it's each little conversation that has stayed with me, and what I look forward to in this next year and next 40 years is being able to utilize that information to define and shape the world that I want to see. And so I want to see more emerging managers. I want to see more spin outs. Or I want to see large firms getting smaller and acquiring people and giving them the keys of their firm. Because the time is now and we can't wait.
See you later, Allocator.
After Portfolio Tile, investing with a smile.